July 2020, also Bitcoin Sydney 2020. This is a double whammy meetup because it's a very important topic that we should all be considering, especially because it's tax time here in Australia. We all don't like taxes, but we all have to pay it. So let's pay attention today. I have on the call Shane from CryptoTaxCalculator. And Sid from PopTax and Jess. I'm going to let them all introduce themselves, then we jump right on the presentation. Jess, do you want to go first?
Hey guys, my name's Jazz. Thanks for having me on again. So I have some legal experience with crypto and blockchain. I worked for a while at law firm Kingwood Mallisons, and I'm currently working in operations and policy at FinTech Australia.
Sid?
Hey guys, I'm Sid Catchwella, co-founder of PopTax and Pop Business. With these two companies, we're trying to change the delivery and the service of tax, trying to make it less painful, which I think, Adriana, you've mentioned everyone hates doing, but you know, it's why we exist, to help everyone get through tax time a little easier.
Shane?
Hey guys, Shane here. I'm the founder of CryptoTaxCalculator. It's basically kind of like a bookkeeping service, think Xero or MYOB, but for crypto taxes. Before that, or still currently, I'm also a software engineer and a bit of a punter on crypto myself.
All right, so we're going to be talking crypto tax obligations in Australia. Everything that we talk today is not financial or tax advice. We are just laying down the information that's already available to you. Obviously, after this call, if you have other questions of personal nature, you can get in touch with Sid from PopTax. He'll be able to help you there. But keep your questions hypotheticals or non-financial advice. All right, so let's go. Shane, do you want to kick off with your presentation?
Yeah, thanks, Adriana. Let me just share my screen. Okay, so hopefully you can see this loading up now. All right, so today we're going to walk you through this, myself and Sydney. Essentially, I need to give out this disclaimer before we begin. All the information presented herein is the opinion of myself and Sid, and it's for general information purposes only. There's no information in this presentation that should be construed as tax advice, and you need to be seeking out a qualified tax professional such as Sid, who can understand your individual circumstances and give you specific tax advice if you require. But having said that, we're going to be talking about our favourite topic, which is crypto taxes. So why is it so popular at the moment? Essentially, the ATO has been sending out an email like this. Started sending it out, I believe, around the 28th or 29th of June to around 350,000 people in Australia, reportedly, which is basically warning people who've interacted with cryptocurrency that if they've disposed of cryptocurrency, that usually that could result in a capital gain for tax purposes, and that they basically need to address that. So this has come out of a situation where a lot of people who've been interacting with cryptocurrencies aren't actually aware of the tax implications. So perhaps they know that, if you make a lot of money, there might be some taxes involved, but they're not aware that things like trading Bitcoin for Ethereum might be considered a capital gain event. And the ATO is just generally trying to increase awareness within the market, I suppose, before they start analysing people in more detail. So we've just got some information here which the ATO actually has provided on their website. Obviously, I can't give you any specific tax advice, but essentially they're talking about transacting with cryptocurrency and how different types of transactions can be a taxable event. The thing to really keep in mind is any trading of exchanges of cryptocurrency including the disposal of one cryptocurrency for another cryptocurrency. So that can catch a lot of people off guard. If you're anything like myself back in the day, you've probably traded on all types of exchanges and weren't really keeping any record, thinking that you only needed to pay taxes once you've converted into Australian dollars when you decide to cash out, supposedly. But essentially the rules here kind of indicate that every transaction, whether it's a crypto to crypto transaction or something back to fiat currency, is actually a taxable event. Things like selling or gifting cryptocurrency might be considered a taxable event. And you've also, if you're using cryptocurrency to obtain goods and services, a lot of people seem to think that, this would fall into personal use asset class. But you've also got to be careful about that and talk to somebody about those situations as well. So yeah, this is more about the crypto to crypto transactions. They're pretty clear that this is going to be a disposal of capital gain asset for another one. Essentially, you need to be recording everything back to Australian dollars. So even if you've been trading on an exchange in the Cayman Islands and they don't have any concept of Australian dollars on their exchange, you need to somehow be able to measure what the value of that cryptocurrency was at the time of the transaction and record that for capital gains purposes. It's just a little bit more about cryptocurrency as an investment. You can see there's quite a lot of information on the ATO website, but essentially capital gains rules apply most of the time. Things like long-term investments over 12 months and the capital gains discounts, you could be claiming that. But then you've also got to look out for certain types of transactions that can be considered income as well. So the ATO came out and talked about particular categories of transactions such as staking and airdrops and things like that, and how they consider this to be income for tax purposes. So that's something to be aware of as well. Essentially what this means is that if you've been even a somewhat regular user of cryptocurrency, even a dabbler, it's very easy to rack up a lot of different transactions across different exchanges. If you ever traded crypto to crypto before, usually the exchange will break up the transaction into multiple different transactions. So it's really hard to kind of keep track of all of this. When I realized the tax implications for myself about 2.5 years ago, I'd had maybe about 1,000 transactions at that point with, airdrops, mining, exchanges, etc. And then basically you have to try to aggregate this all together and convert it back to Australian dollars. And it could take, if you're going to do it manually, which is when I first started to do it, it can take days upon days, which is why I've kind of put together the CryptoTaxCalculator tool to kind of manually automate that system. So this is some of the output that I'm talking about, which you get from exchanges. As you can see, it can be pretty difficult to understand. For example, here you've got the market, which is zero chain to ETH for this top transaction. There's no mention of Australian dollars whatsoever. You've got a date format here, which might be in UTC time, or it might be local to the exchange's time, who knows? And then you've got the different fees here, which might be in what cryptocurrency. We've got it here, ETH. So you can see these types of transactions are really don't have anything to do with Australian dollars. And if we go back to the record keeping of the ATO, you're meant to keep on record the date of the transactions, the value of the cryptocurrency in Australian dollars at the time of the transaction, which can be taken from a reputable online exchange, and also what the transaction was for and who the other party was. So really, if you're getting CSV outputs, for example, on some exchange in the Cayman Islands, etc. You don't really get any of those records up front, and you've got to somehow put that together so that if you get audited by the ATO, you've got some sort of audit trail to prove how you came up with the calculations behind your taxes. This is some more examples. So this is just a different exchange. It's quite a common theme that you'll get trade crypto to crypto, and there'll just be no reference to any fiat currency, let alone Australian dollars. So yeah, really need something to help you here. That's why we built this crypto tax calculator. So if you've made lots and lots of different transactions, you can just basically upload your CSV files, and we've taken that hard work of trying to work out what the format of that CSV file is and passing that through into something that's more appropriate and accountant friendly. And then we'll give you the option to import it here. So you just get kind of like a couple of steps with directions on what you need to import. You can import via CSV or API, and it'll sync everything automatically. And then you'll be able to review your transactions. So depending on the type of transaction, it might be, a crypto to crypto transaction. So we'll just convert that into Australian dollars there. Or it might be something like a wallet import. So if you've imported if you've done decentralized financing or anything like that, and for example, you've had your wallet stolen, you can mark that as categorize it as stolen, and then we'll give you some outputs for that. There's a lot of different categorizations there, which we'll go into later. But essentially, you get kind of like some nice looking reports after this, which you can use as guidance to work out if you're in the right direction or not. And you get an end of year portfolio to give you some more guidance, and you can break that down by financial year as well. And the most important parts are that you can now see that you've got the record keeping in a format that is reasonable. So prices are back to Australian dollars now. These prices are based on exchange prices, so reputable exchanges. We try to use the exchange that you are transacting at. If that's not available, then we'll go to a third-party provider for this. And we also give you the proceeds report as well. So you can take this all to your accountant, and someone like Sid can make sense of it all and be able to, we can add that into his software tool to generate a tax file return at the end of the day. So Sid's going to talk to you a little bit more about the crypto taxes in details, but yeah, he's been working with him for a number of years now. He's been around since 2014, and since I've known Sid, he actually approached me originally. He's been really on top of everything, and he's been doing my taxes absolutely fantastically. So I'll just put you on, Sid.
Great, thank you, Shane. Thanks for that. Do you mind stop sharing, and then I'll share from my end. Thanks, mate. Great, just making sure it works. Cool. You all see that? All right. Yeah, thank you, Shane. So yeah, I met Shane quite a while back to discuss how, in the Australian market, it is quite difficult to prepare your tax, make sense of it, lodge it with the ATO, and, not be stung with a massive bill from accountants that are trying to, price gouge because it's such a new niche in the market. With cryptocurrency being so new, there's only a few providers that have the expertise able to put it together and lodge it compliantly with the ATO. So I think what a lot of crypto investors are finding is, how do I do proper record keeping, right? So, and I think that's why Shane's product, being Crypto Tax Calculator, is so useful, is because all those integrations with the exchanges and being able to download and upload your wallets and putting it all into this one massive database that could figure out what the tax consequences are for each trade, that is so valuable. And that's why, looking at how can tech better serve the public in making sense of tax, I thought it made sense to reach out to Shane and combine the reporting that CryptoTaxCalculator provides and PopTax, which is an online tax return platform. So you could either do it self-serve, or if you like it the old-fashioned way, you can reach out to a PopTax team member who can take you through the whole return. So yeah, with all that, just introducing myself, Sid Cachuela. I've been a chartered accountant since 2014. I've dabbled in financial advice, worked at a top tier an accounting firm. Specifically about me, I love innovation, I love strategy, and bringing all that together to make an impact on individuals' financial well-being, but also for businesses. So PopTax is one side of the business we look after, which is individuals. And for those of you that are running your own businesses, we have a B2B service which is called Pop Business. So, but basically they're doing the same thing. How do we give you amazing tax advice and give you a great experience as well? So just about PopTax, it's built with tech in mind. We try to be inventive. How do we make the customer journey really easy and don't bore you with jargon? Because at the end of the day, not everyone did a 4-year degree doing accounting or tax. So it's how do we simplify this, simplify the tax process, giving a good experience, and then, giving peace of mind at the end of the day that an accountant is looking at your tax return and making sure that all the dots are dotted and the T's are crossed. So, and amazingly, it's Australian made. So, and that's just some Google reviews. So we've been operating for the past 2.5 years. So this is our 3rd tax season. And I think the platform has gone from strength to strength. And I'll give you a bit of a look in how the reports from the CryptoTaxCalculator that Shane's company produces can be used in conjunction with PopTax. So when you create an account with PopTax, similar to the ATO, you'll have your dashboard where you can manage your tax obligations. So if you haven't done your 2019 or 2018 and you need to do it, you can do those. If you need to do older, you can definitely do that as well. So we're coming into the 2020 tax year. And then once you start one, we break down the tax return into 4 easy steps, being your deductions. So the great thing about this is we've built out questionnaires tailored to each occupation. So hospitality, nurses, teachers, defense force, we've built that all in. So when you select your occupation, you get a list of, over a dozen questions that'll help you max your tax back. And then, so once you get to step 2, you add your employment income, which is very straightforward. Get it from your payment summary. Input your income, tax withheld, your employer. You can attach your document so that you can keep it on file for next year. And then this is where the cryptocurrency trading, which is a new module that we've introduced this year, is where you can input the outputs that you get from CryptoTaxCalculator. So just going through the prompts, did you mainly use cryptocurrency to pay for personal goods? If you click yes, the system recognizes that it's a personal use asset. So it'll bypass this section, and then obviously there's no CGT on those transactions. But if you didn't mainly use it for personal goods or services, it's likely that you would have experienced a CGT event during the year. So you click yes, and then you just input from Shane's program, the net capital gain, total current year capital gains, net capital losses from previous years and this year, which can offset and give you the net position. And you can attach the file so that an accountant can look at it for you once you submit it to PopTax. So as you can see, we boil down everything down to just these simple inputs, and working with CryptoTaxCalculator makes it, a 5-minute, 10-minute job. So yeah, as I was speaking before, tailored deductions, these are just a snapshot of some of the questions you'd be asked. So if you got mobile expenses during the year, you can claim your mobile phone for work, and then you go put down a percentage, and it automatically calculates it for you and gives you a calculation on the right side so you can keep track. So yeah, that's just a bit about the platform. So I'll step back again into going into, I guess, the situations that we commonly experience when dealing with crypto. So just expanding on what Shane was saying earlier, I'll go through a few case studies, which should encompass the majority of people's situation with crypto. So this is probably the most significant type of transaction event that most crypto users will experience, which is crypto to crypto. You bought some Bitcoin, you're selling into Ethereum, you sold out Ethereum, you bought into Ripple, and then you just, everyone, you might not think, why don't I just get taxed from the initial input? And then if I go through all these trades, why can't I just be taxed on the end result minus the start result? But unfortunately, because you're dealing with different assets, it becomes into, it creates different investment assets. So each of them will have its own cost base, its own proceeds, and which leads into a capital gain or loss every time you switch into a different coin. So for this one, Alex purchased coin A for $1,000, which becomes its cost base. Within 6 months, Alex exchanges coin A for 20 coin B. Effectively, the 20 coin B is worth 1,500 at the time of exchange. So it's considered that coin A has been sold for 20 coin B at the value of 1,500, which effectively represents its capital proceeds. So in that transaction itself, in effect, you're making a $500 capital gain. This is disregarding any transaction costs, of course. But in this situation, $500 capital gain has been made, which is $1,500 less $1,000. So subsequently, well, stepping back, 20 coins of B is said to be bought and retains a cost base of 1,500 at that point in time. So subsequently, if 20 of those coin B is converted into fiat 2 months later, so into AUD for 1,200, the result is a capital loss of $300, which is the 1,200 less 1,500. So now you've got these two transactions that have happened throughout the year. One, you've made a capital gain. The other, you've made a capital loss. And if these two events happen in the same financial year, the total result is a capital gain of $200, which is that initial 500 you've made, less the 300. So this becomes very complicated because, you might be exchanging dozens of times throughout the year, and it's hard to keep track of what the AUD value of that next coin that you get is, or even the initial coin. So it becomes unwieldy, and which is why, Shane's crypto tax calculator is really good at being able to figure that all out for you. So case study 2, which is probably the most, it's probably the second most likely transaction to occur. So Alice purchased 100 coin A for $500, including transaction fees, and holds a coin for 6 months. So in scenario A, Alice then sells the 100 coin A for $1,000 with a transaction fee of $5. So the reason why I'm including the transaction fee is to show you how it joins in to form the cost base, which is an important term for tax purposes. So in scenario B, Alice sells the 100 coin A for $400 with a transaction fee of $5. So I'm trying to show the difference between the capital gain and the capital loss here. So in scenario A, where you've sold it for $1,000, you've resulted in a capital gain of $495, which is $1,000, which is the capital proceeds, and the cost base, which is the cost of what you initially purchased the asset plus any transaction fees. So in this case, it's $5. And if you've held it for longer than 12 months, you sort of gain access to that 50% CGT discount, which you may have heard of more primarily in stocks and shares. So same applies for cryptocurrency as an investment. So in contrast, scenario B has a capital loss of $105. So this, where the capital proceeds is $400 in scenario B, the cost base still remains the same, which is the $500 when you bought it, and then plus the $5 transaction fee. So the main takeaway from here is make sure you consider all those fees when purchasing and selling your cryptocurrency, because then that may change the cost base, which will affect your tax position. So case study 3, personal use asset, where a lot of cryptocurrency investors would wish most of their buys and sells were part of, because this sort of leads into not paying CGT because you're using it like in response to money. You're using it instead of money. So in this situation, Karen saw a pair of jeans online, and there's a 10% discount for customers that pay in Bitcoin. So she thought she'd take this up. She's purchased $300 of Bitcoin from a crypto exchange and uses it to buy the pair of jeans. So the primary reason was to exchange Bitcoin, to use it as a form to buy personal use asset. And in this transaction would not be considered subject to CGT. So when you're looking at different types of transactions, what you need to consider really is, is there a profit-making intention? Obviously, in this situation, there isn't. Karen just wants to get a good pair of jeans at a good price. The nature of the transacting, again, is it trying to invest? Are you trying to make money? And of course, the frequency of transacting personal use assets. So if you're throughout the year, you're buying and selling as an investment, those transactions are definitely not going to be considered personal use, because your intention is to speculate on the market and try and make a gain in form of fluctuations in the price. Is everything all good at the moment? Any questions or?
Yes, I have a question, and I was gonna save it because I don't know if it will apply to any of your other case studies, but in case of personal use, what if Karen, was that her name? What if Karen got paid in Bitcoin for a service that she provided?
Yeah, so.
And then she used to pay her credit card bill, for example.
Yeah, so the tax consequences is primarily on the employer there, because if the employer is paying an employee for their work through a cryptocurrency or Bitcoin, then they'd have to pay fringe benefits tax. So that's a separate situation. If you're the individual, you'd be receiving it in a form of like wages. So in that case, you would potentially just consider it the AUD value and put that into your tax return as a salary and wages. So when she's using it to purchase other things or pay off the credit card, hypothetically, I think you'd have to consider that as a personal use asset. She hasn't acquired the cryptocurrency to profit from it. It's just by way of getting paid. But each situation will have its own, nuances. So I would sit down and flesh out the whole entire scenario, because, one thing could lead to another, and then, there potentially is a CGT event happening, but we need to look at each case.
Yeah, because she could not spend her whole wage, and then there will be a portion there that could probably qualify in the future for a capital gain.
Potentially, if she just holds on to it and then she just continues to buy goods and services with it, and she's not really trying to convert it into another cryptocurrency and flip that over. You know, there's a strong argument that it's considered as a personal use asset, whereas if she's just held it and then she's just changed it into fiat over time because, you know, she just wants to get some cash out, then, you know, you can argue it both ways. It's really dependent on the intention. So that's why you need to talk with an accountant to really figure out what's the intention behind it, what's the frequency, and what's the nature of those transactions.
Karen, if you're listening, that's what you need to do. Talk to Sid. Okay, moving on.
So case study for business activities. So in this situation, Zach's just employed as a barista, which helps the economy going because everyone needs coffee. His friends got him highly interested in cryptocurrency trading activities. And what makes Zach's situation particularly different, every day he's researching, conducts analyses of changes in the market, including, you know, reviewing daily news articles, determining the structural changes to cryptocurrency businesses, potentially the exchanges, the actual companies itself, and the market as a whole. Zach intends to make a profit and genuinely believes that his processes will allow him to make a profit. And he keeps well-kept accounting records to keep track of his profit and loss, to make calculated and informed changes in his portfolio. In this situation, you know, you could probably strongly argue that it wouldn't go in the capital account, so there's no CGT events. It's more you're running a business, so you can the profit and loss from each trade will form part of assessable income as terms of like a revenue account, not capital. So there's no, it's not considered a financial asset in that respect. So the key determinants in determining if you're a business is whether the operations you're conducting is business-like and commercial in nature. And what forms some of those factors is the regularity of you trying to make a profit from making calculated risks, assessing the markets, and just not making it so much a speculation. You know, in 5 months' time, I know it's going to be 10 times. You know, that's more considered capital in nature, because you're going for like a fluctuation and a speculation in the long term.
You're trying to profit from the fluctuation.
Yeah, and in this case, he's making calculated risks, calculated bets. Like you might be doing technical analysis, and you can see, you know, we've hit a support line, and there's a strong possibility of a rebound off this support line. So, you know, it's just about how you piece everything together, present it to an accountant, and how that accountant presents it to the ATO, which will determine whether it's going to be like a financial asset or it's going to be, you know, it's more of a transaction, profit and loss in nature. So scale, amounts of money, length of time in the transaction are also factors you need to consider in this situation. So lastly, the case study 5, loss or theft. This can happen, you know, if you lose your private key, which is your gateway into your vault of cryptocurrency. If you lose that, you know, you won't be able to access it indefinitely. So you may be able to claim a capital loss there. And there's a few things that I've listed here which can help you build the evidence to support that capital loss, because these are the things you'll need to present to the ATO, and they'll assess it and determine whether you've legitimately lost your private key, or, you know, it's been stolen. One thing to note, it's, you know, if you've got the public key, you'll be able to see that balance sitting there, and if it hasn't been touched for years, you could argue that no one has access to it because you've actually lost it. So that's one way of providing evidence.
You have to be a long-time hodler.
Yeah, long-time hodler, but no one benefits because, well, no one's going to get that cryptocurrency at the end of the day. But in this situation, the investor has lost all that sort of investment. So in this situation, if they can prove loss or theft, they'll be able to claim a capital loss, and capital losses can be offset against future capital gains. So something that can be very useful to the investor. So from those 5 case studies, you can see that it can be quite complicated to figure out each little scenario and transaction. Is this capital? Is this personal use? And I think the next best thing is to combine the record keeping capabilities and tax estimate from CryptoTaxCalculator, combine that with PopTax, which will allow you to lodge it easily and to get the peace of mind that it's done correctly. So yeah, Shane and I, we've put this landing page together where you can register your interest to get a discount from Shane and I to get your taxes in order, even if and I know a lot of cryptocurrency guys, they're like a few years behind because it feels so hard to get over that dread of like, I don't want to look at even if it's a loss or even if it's a capital or a gain, there's going to be a significant result that they'll need to deal with. So we're trying to make it easier by trying to take the pain away and get you a definite result at the end of the day. So CryptoTaxCalculator for the reporting and PopTax for the self-serve platform. And if you're a business, visit us at popbusiness.com.au. So yeah, that's me. Shane?
Sounds good.
Shane, I have a question for you. So the CryptoTax just tracks transactions from exchanges. Am I correct?
No, you can pretty much track anything in CryptoTaxCalculator.
Yeah.
Primarily, the most common use case is people who've transacted on exchanges. For example, you might have used CoinJar in Australia and then sent that money over to Binance, wherever that's based. But also we support a whole lot of other types of transactions. So you can import your Bitcoin or Ethereum wallet. For example, if you did Ethereum, you can do your staking transactions. You can get covered for airdrops. If you've done any decentralized finance, like lending out your Bitcoin to receive interest, there's a lot of different, like if you've received income from Bitcoin, like what Karen did. So yeah, that's all kind of like, you've got the centralized exchange and the type of everyday transactions which somebody might be doing if they're punting on the price of cryptocurrency. And then you've also got the whole cryptocurrency ecosystem.
So I'm assuming with payments would be like, let's say if Karen got paid in Bitcoin, she will have to enter that manually, but with the wallets, you just connect them? Is that
well, sure. If you got paid in Bitcoin, it would have to be sent to a public address. So you can just add that public address into the CryptoTaxCalculator, and we'll actually pull in all the transactions from that public address into the calculator itself, and then you can go ahead and kind of categorize it. So it's a lot like an Expensify or something like that, where you can kind of connect your bank account details and just imagining that your public wallet is your bank account, BSB account number or whatever. And we'll just read, because everything's on the public blockchain. There's nothing really private unless you're using Monero or something. And then you can basically go through and kind of categorize those transactions.
Too easy. Is there a cap for transactions where tax apply? I remember hearing something back in the day about $10,000 or less.
Well, I'll let Sid talk about this one, but yeah, I think that's around the $10,000 threshold for personal use assets that you're talking about. Sydney, do you have any?
Yeah, that's right. That is still valid. Looking at the ATO's sort of guidance on it, if you purchase, if there's a capital gain from that personal use asset of over 10 grand, then it's going to be subject to CGT. So yeah, be mindful of what your one Bitcoin's worth, and make sure that it's well within reason. You know, manage your financial situation in a way that, you know, benefits yourself, but you're still within the government's guidance and tax rules.
I've got a question, Shane. So with CryptoTaxCalculator, does it, the outputs, does it let you know when you received an asset and then when you've disposed an asset for the purposes of a CGT discount?
Yeah, so when you import all the transactions, or however you go about doing it, say if you've imported a wallet, then we'll have a look at the timestamp against that transaction. So, and we'll convert that back into local time for you. And then we'll kind of use that timestamp to kind of value the transaction, given a reputable exchange, or if we can get the value of that transaction based on kind of the data that you've given us as well. Yeah, so we kind of, what we'll do is kind of order everything. Say you might have traded across lots of different exchanges, for example, we'll order that into like kind of a single timeline, I suppose, or what I reference is like an accounting ledger. And then you can apply your different inventory methods against that. So you might have bought Bitcoin on Monday and Wednesday and Friday, and then you sold on Saturday. So then we'll have a look at your first in, first out method, for example. So you'll take your Bitcoin from Monday and sell that first and work out your cost proceeds from that. And then you'll go in on Wednesday, and if you've got some more Bitcoin there, then you can sell that as well, depending on how much you're actually selling. So there's different kind of inventory methods. You kind of need to talk to your accountant about which one you want to be looking at. Everything's going to move back, match back to the timestamp of that transaction on the blockchain.
Yeah, sorry about that, Shane. Yeah, I'll add to that because, yeah, if it's first in, first out, you'll get a certain result. And then, you know, in some situations, you want to choose the parcel of coins that you want to sell, because you might want to hold on to the initial coin for over 12 months so you get that CGT discount. But, you know, there's these little ways that you calculate the results depending on which parcel of coins you want to share, which will significantly change the tax result. So it is a little more in depth, but, you know, if you take time and you're trading significant amounts, it can be quite beneficial from a tax result, because if you're dealing in thousands and thousands and you do it one way, you're definitely going to get one result. But if you take a little time, you ask an accountant to, you know, spend time on this and look into each type of transaction. Should it be first in, first out, last in, first out? You know, should it be weighted average? Like there's, you know, really, this is where a good accountant will add value.
Okay, cool. That makes sense. Thanks.
I think Shane mentioned something about being able to do DeFi with the CryptoTaxCalculator as well. How does that work?
Yeah, sure. So essentially, what you would do is kind of import your public wallet key, and then you'll pull up all those transactions against that public address. And initially, you'll just have in or out, like we'll just label it in or out, similar to if you're on Etherscan and you can see your wallet address there with in and out transactions. And then you could go through and kind of categorize them. So, for example, if you've deposited your Ethereum onto one of those collateral kind of exchanges for true US dollars or something like that, and interest on that, then that interest going into your account, you can label that as interest, for example, and then you can just go through and label everything appropriately. So you've got quite a few different categories, and the different categories do have different kind of effects on the calculations. And then you can kind of take that report to SYD and he can kind of analyze that for you and make any recommendations on the categorization as well. I was thinking about doing a live demo, but I might refrain from that.
So from a management point of view, do you think it's better to do this like ongoing basis, like on a month to month, just keep on top of your spending or of your transactions?
Yeah,
rather than
absolutely.
just leaving it all for tax time and having to remember.
Yeah, I mean, it's one of those things, right, where it's really easy to push the can down the road, but at some point you have to meet your master and do your taxes. So I definitely recommend trying to keep on top of it. It's just like any type of accounting software with expense reports. It's a lot easier to do, especially if you've got quite a few transactions, to be able to do that regularly rather than kind of scratching your head at the end of the tax year or scratching your head after 3 or 4 years when you've received the letter from the ATO and trying to remember what those transactions were back in 2017. Yeah, it's definitely a lot easier if you do it at the time of the transaction or soon after, so you're not trying to collect your thoughts like it's using the blockchain as a diary.
So the more transactions you have, the more you have to stay on top of those if you don't want to go.
Absolutely, yeah. Especially if you're in the decentralized finance world, like if you're doing any types of trades, and some of the interest that you can earn from in that space at the moment is quite high. So, you know, lots of people are kind of heading in that direction. But you really want to be keeping on top of it. Like some of these staking rewards, they might be sent to you weekly. So you want to try to keep on track of that. Like something like our tool, we're going to be adding some automations around the Ethereum staking rewards. So like it automatically gets categorized for you and then you can just edit it. But yeah, definitely a lot easier if you don't just leave it until another day, because I guess the problem with most people is that they just feel that it's all a little bit overwhelming. They don't quite understand how to manage it in the first place. They're even struggling to try to get the raw exchange data, like just trying to recall what exchanges they might have used back in, say, the ICO period in 2017. Like, so it's definitely better to keep on top of it. Once you've gone through that pain, you'll realize that it would be a lot less if you just did it day to day.
Yeah, I'd echo what Shane said, because it does get unwieldy and it does become burdensome. But the benefit of keeping track month to month is also that you can affect the end tax results. Because you know, if you were purchasing Bitcoin mid 2018 and then you know you rode that up to what was it 25,000, and then you were like happy days, and then you sold it out into something else. You've crystallized that gain, and then say you held it on until like now, that gain is still there, but you know the loss, now you have less money because that 25,000 is now worth, what is it now these days?
10,000, yeah.
10,000. So you're getting half the money back, less than half, and you have a big tax payable. So you've sort of hit the double whammy there, where your investment's done poorly, but because the reporting hasn't been done, where you could have made like a proactive effort to change that, you're stuck with a big tax bill as well. So you know, when you're putting in money, it's very important to take it seriously, because at the end of the day, you know, we're all in this to benefit.
Yes. Okay, so there's many different scenarios. If you fit into any of them, just give those guys, send them an email, get in touch. I think there will be like a discount code. There's already something on the notes for, you know, everyone in this meetup. And Jess, do we have any more questions?
We've got a question in the chat from Mitchell. It says, is there a difference between earning a governance token and a USD stablecoin for tax implications?
Ooh, deep.
That's
Thanks, Mitch.
thanks, Mitch. So the difference between USD stablecoin and governance token. Yeah, you stumped me, Mitch. You stumped me. I'll have to look into that, do research. But that's why, you know, we've got a team that will look into the very specifics. But, you know, don't know that off the top of my head, sorry.
There you go. You can always count on Mitch to ask the difficult questions. We'll get back to you on that, my friend.
I wouldn't say, like, just from what I'm thinking, like, hypothetically, they're both types of tokens. So at the end of the day, they're going to be denominated in some AUD equivalent. So if you're an Australian resident trying to figure out your tax position, it'll go back to case study 1, where did you buy the first coin, sell into a second coin? If that's the situation, you're going to figure out what the AUD denomination is and then work backwards to find out the capital gain or loss. Just because they're called something different, it doesn't make a difference. At the end of the day, they're going to be considered financial assets. So specifically, like what happened to the USD stablecoin, I don't know. What's happened to the governance token, I don't know. But at the end of the day, they're going to fluctuate in a certain price, and that'll determine what your tax outcome will be.
So all assets are made equal?
Well, tax is made equal, you know. But I guess the naming conventions isn't. But yeah, you know, we'll have to look at that more in depth.
Right. Any others? Let me check.
Yeah, there's one from Rosalind. So this is to you, Sid. She says, are you saying that if I bought a Bitcoin for $400 years ago, I have to pay tax on it for being worth 25 grand? I think that's just a clarification on a point that you made just before.
So it depends if you've sold it. So the CGT event, which is the capital gains tax event, only occurs once you sell. But if you've held that Bitcoin, which you've bought for $400, and you've still held it, you haven't transacted in it, there's no effect. There's no tax effect until the time you sell it. And then say if you sold it now, because the financial year has just ended, you'll include it in your 2021 tax return. So you'll just figure out, did you get more for it? If so, then you've got a capital gains. If you got less than $400, which of course it isn't, it'll be a loss.
So that's an important thing. You only pay capital gains tax once you sell the asset.
Yeah.
If you hold it for 10 years, you just have to report it, right?
Yeah, you'll just have to report it. So once you sell it, that'll be considered a tax event, and then you'll just include it in your tax return, pay off the tax bill, and you know, potentially it's not that bad, and you've got a gain, so you're ahead.
Do we pay capital gains tax on savings when you keep your money at the bank?
No. So keeping your money in the bank, you can think of it like staking. You've got money in the bank, and then every so often the bank will pay you some percent. You know, it's very you know, it could be, you'll pay on the interest. So the interest will form part of your assessable income, and then you'll pay tax on your marginal tax rate on that income.
Because I guess this is important information for the hodlers, because many people now save in Bitcoin or whatever their preference in token. But yes, if they don't sell, they don't have to pay capital gain taxes until that happens. Mm-hmm. And if it's, you know, you lucked out and you're just gonna sell when it's $1 million for Bitcoin, then you'll be happy days anyway, so it'll be fine.
Yeah, you've done well. You've done well if you sell it at $1 million.
Just have to be patient because it's a long way away.
Yeah.
Oh, you never know.
Well, I have Bitcoin, my superannuation, so hopefully by then I'll be laughing. So, is there any the implications for people who have crypto and the tax are different?
Sorry, Could you?
So for those people like myself, this is not a hypothetical, but if you don't want to answer this, don't. The tax implications for people who have crypto in their super, are they different?
So that's quite complicated because super tax, well, tax in super is different to tax individually. They're two separate entities. So in super, if you sell within your super fund and all that stays in there, still the 50% CGT discount stays the same, like if you held it for over 12 months, but then you only pay, it's not a marginal tax rate that you pay compared to like an individual. Like, as you know, individuals, as you earn more income, you're up the progressive tax bracket. In super, it's a flat rate. And I think from memory, it's 30%. So if you consider that, if you've got a CGT asset and you've sold it, held it over 12 months and you sold it, you get that 50% discount, and then you only pay 30% tax on that gain. So it's even less than if you held it outside, because outside you don't have that that flat rate.
Yeah, it's becoming an option for a lot of people to have some crypto in their super.
Yeah,
that's because of that. It's from having any investment in your super, it's a little bit better in the long run, right?
Yeah. Everyone has their risk tolerance. Like, they may want to include cryptocurrency in their super because they're not going to touch it for so many years. If you're patient and you believe it's going to increase, then this is not financial advice.
No, it's not. my personal preference. Okay, let's see. I think we're good. No more questions. Jess, you have any other questions?
Full of questions.
We have 2 more minutes.
Okay, so just quickly, in terms of airdrops and like hard forks and those kinds of things, is it correct? I mean, this is just my understanding, could be completely wrong, but is it correct that the ATO's stance is that a zero cost basis is applied to things that are derived from those events? Or is that again something that's more complicated and you have to consider on a case by case?
I'll just share my screen on that, Sid. Came out with some particular guidance on that recently, actually, in particular around airdrops. Here we go. Yeah, so what they're saying here is that when you've actually received it, it's considered ordinary income at the receipt.
Okay.
And then the gains or losses after that would be you're using that value when you've received it. From my understanding, I'm not an accountant, but in the app, we calculate that as kind of the value of the cost. And then, what you sold it at would be a capital loss or gain.
Right. Okay. Yeah, because I was kind of just like thinking about that in terms of projects like EOS, where it was an airdrop to facilitate like chain swap. They moved from Ethereum over to their own platform.
Okay, so you're talking about forking. Sid, do you have any comments?
Yeah, we just usually follow the ATO's guidance, but this makes sense because it seems to me like it's interest, we've got some kind of assets and it's allowed you to get this, this extra airdrop or, new token. So, it's really hard to value that. So it seems like the best way to value that is at the time at which you receive it, and then considering that accessible income. So I guess at the time of sell, when you sell it, your capital gain is actually reduced by the accessible income you've included. So say this token was worth $10, and then you sold it, a few months later for $20. You've got a $10 capital gain, but you can reduce that gain by the accessible income that you've included in your tax return, which will be the $10. So it'll sort of net out in a way, but you still pay you still pay the tax rate on the $10.
Okay.
Something on that point you've got to be aware, like if there's the Bitcoin fork and now you've got Bitcoin Cash and you haven't sold either of them, you need to be talking to an accountant as to whether you still have taxes, because maybe the fork itself would be considered income tax. So that's a gotcha.
What if you didn't claim the fork?
Yeah, so that's pretty interesting.
Because you didn't want anything to do with that coin.
Yeah. I mean, I've got questions about that myself. Like, what happens if somebody just randomly sends me an airdrop token of Definity, for example, it's $1,000 worth at the time, and I didn't even know. And then I found out like a couple of years later. What happens then? But I mean, what happens if someone gifts you $1,000 into a bank account that you didn't know until you checked your bank account 2 years later?
Yeah. In those situations, if you figure out 2 years ago that you got this income and you didn't know about it, technically you'd have to amend your tax return. So I think, Shane, we were talking earlier that there's a lot of crypto investors that are amending a lot of their tax returns because of incorrect reporting. So that's a big issue at the moment, because they've talked to accountant that hasn't really had this experience in the past, so they're just probably using the cost base at the start and then had thousands of transactions, and at the end they've just taken that proceeds and then minused the cost base, and then that's not really the way to do it. So I think a lot of investors are getting caught out doing that at the moment.
Awesome. I guess we ran out of time. Thank you so much for sharing your knowledge with us today, Shane and Sid.
Mm-hmm.
I will put the links that were in your presentation on the description of this video, so everyone can have a look and get in touch with you. Hopefully you will help lots of us to do our taxes, Sid.
For sure. Anytime.
Using Shane's CryptoCalculator. And just a quick disclaimer, the blockchain professionals in BitcoinSYD meetups did not make any coin for this meetup. This is not sponsored by these guys. They're just, doing their bit like we all are, trying to get the knowledge out there. So this is a not sponsored meetup. The discount goes to you, not to me. Or to Jess.
Yeah. Thanks, Adriana and Jess, for having us. It was great to share some knowledge with your audience, and hopefully they got a lot of value out of it.
Absolutely. I'm sure they have. Read the comments later on. There were some other interesting comments on the chat.
We'll have to read.
Right.
Thanks everyone for tuning in. Bye, y'all.
Thanks, guys. See ya.
See you next month. Okay, the stream is ended.